What if the biggest reason people lose money isn't because of bad luck or that they're bad with money? What if it's simply they're bad at timing? I mean, imagine investing right before there's a crash, or saving all your hard-earned money during a economic boom when you should be investing. Cycles, economic cycles, market trends affect every financial decision you make, from investing and borrowing to starting a business, even changing jobs. Greeting and good morning. Welcome. So today we're going to discuss the economy and the market trends surrounding all that. There's a lot of trends in the market, in the world, that go well beyond the scope of what I'm going to cover here. Ray Dalio has a book out there right now, The Changing World Order. If you really want to get an ultra macro view, I recommend you go read that. But understanding these cycles and how you can use this knowledge to protect your money, build wealth, and make more confident choices with your money, with your investments, no matter what the headlines say. So, what is an economic cycle? So, the economy doesn't grow in a straight line. Think of it like a roller coaster. It moves up in cycles, it moves down, back up again, sideways. But overall, there's four basic cycles to your economic and market cycles. First is your expansion, where you've got businesses booming, jobs are plentiful, people are spending, life is great, rainbows and ponies all over the place. But then you reach a peak. Everybody's excited, seems great, hands are up in the air, but you've reached kind of a high point. And this is where you got to be careful. Inflation may start rising, and markets can get what's called overheated. Too many people investing too much money in the markets. Following that, you're going to have a contraction. Could also be called a recession. Job losses, your falling stock market prices, and lower consumer spending, which is expected in those times. Your trough is the bottom. That's when kind of what's called ultimate fear, ultimate conservative spending. When nobody's spending, everybody is sitting around worried about where they're going to get their next paycheck. This is at or near the bottom when this starts happening. Shortly after that comes the recovery, and then back to the expansion. You can watch these happen throughout time, throughout the markets. But understand these cycles are just natural. As long as you understand them, you can rebalance your portfolios as the economy is rebalanced. So what causes the economic cycles? So think of the economy as a car. When you press on the gas, you're going, right? You're going to have lower interest rates, tax cuts, consumer spending. You've got it. Okay, things are going great. Put on the brakes because interest rates are higher. Nobody wants to borrow at higher interest rates. Inflation's up there, reduced business investment, reduced consumer spending. Everything is slowing down. Core drivers, consumer behavior, Obviously, when people spend, businesses grow. When they save or panic, the economy slows. Spend to grow, panic to slow. Interest rates, which are set by the Federal Reserve to control inflation and growth. As they get higher, obviously that's going to slow the economy. The lower, that's going to give more of a boom. More businesses and people are willing to take loans out. Inflation and deflation, rising prices reduce purchasing power, and falling prices can lead to stagnation. Debt levels, excessive borrowing can fuel booms and crashes. So it's never good to have high debt levels in either case. Some at the trough, and in an expansion, if you know what you're doing, yes, you can take on more debt, but be careful. Make sure it's smart debt. And then, of course, on a global scale, you have external shocks, wars, pandemics, shortages of major resources like oil and gas. All this can trigger and deepen cycles. So how the markets react. Markets are crystal balls. They're prediction engines. They're based on what investors, smart investors, think will happen. A bull market is charging, right? Stock prices rise, confidence is high, usually during expansions. Bear market, slow, means it's going down. Stocks fall 20% or more is technically what it means to be a bear market, 20% or more, often right before or during recessions. Then there are things called corrections, which are 10 to 20% changes in the market. It's usually just a healthy pause for investors. Market psychology. Greed drives prices up, fear drives prices down. So greed is a bull market, fear is a bear market. Smart investors watch the cycles, not the headlines. By the time you see the headlines, the cycle's probably already started or already finished. So what do you do at each stage? During the expansion, if the market's going up, invest in growth stocks. Business ventures, be a good time to start a business venture. Possibly a good time to get into real estate if you're not already. Lock in some fixed rate, low rate loans, business loans, personal loans. Build your emergency fund. I mean, you really should always be doing that anyway, but now's a good time to build up your emergency fund while your income is better, probably more steady. At the peak, you want to start reviewing your investments. Take your profits, especially if certain things seem overheated. Reduce your risk. Reduce high debt. Get rid of high debt. And prepare psychologically. Booms don't last forever, and neither do recessions. During a recession, don't panic sell. Hold on to quality investments. There's a company you know that's been around for 20, 30, 40, 50 years. It's probably not going anywhere. So there's no reason to panic sell. Just keep doing what's called DCA, dollar cost averaging. If let's say you're investing $50 right now at the peak, and $50 is one share of a stock, well, as the recession hits, the price of those shares go down. Your same $50 buys you more than one share. It drops 50% down to 25. Now you're getting 2 shares. Over time, dollar cost averaging will give you more shares and a higher predictability of long-term profit. Again, long-term profit. During the recession, keep cash reserves. It's always good to have cash reserves anyway, especially once you hit the next stage during recovery. To kind of build up your cash reserves, starting at the peak, especially through the recession. Opportunities will appear. You just got to have what's called dry powder. Dry powder there to be ready to take advantage. And look for undervalued assets. Now, most people are not going to take the time to understand all this. They're just going to invest with their brokerage or their 401k, which is fine. Nothing wrong with that. But if you are more hands-on with your investments, this is a good time to be learning how to assess when stocks are undervalued or overvalued. And then, of course, during the recovery, re-enter the market gradually. There still could be some downside. Start diversifying your risk. Reduce your risk. And again, as with all the phases, all the stages of this, focus on your long-term goals. But during the recovery, this is when real wealth, potentially even generational wealth, is built. So how do we track the economic and market trends? Well, first, we look at the GDP, gross domestic product. Measures the total economic output of a country. If it's rising, you've got a healthy expansion. If it's declining, you've got a recession, higher risks. Unemployment rate. If you've got low unemployment, you've got a strong economy. If you've got a rising unemployment rate, possible contraction, trouble ahead. CPI is your consumer price index. Inflation. A little is good and expected, 2 to 3%. But too much erodes purchasing power. Too little is economic stagnation. Your interest rates, your federal fund rate, it's controlled by the Federal Reserve. Rate hikes slow down borrowing, spending, rate cuts boost it. Consumer confidence shows how optimistic people are about the future. If they're highly confident, they're out spending more. If they're not, they're saving more. Your retail sales reports. Strong retail sales means consumers are spending. Just another way to measure consumer spending. Weak sales, obviously they're pulling back. Specific signals to track your stock market indices, S&P 500, NASDAQ, the Dow. Those kind of reflect overall investor confidence. Consistent upward trends reflect optimism. Sudden drops are fear or corrections. Yield curve, when your short-term rates are higher than your long-term, it's often a recession warning. Volatility index, also known as the VIX, it's the fear index. If it's high, there's uncertainty and expected turbulence in the market. Corporate earnings reports, are companies making more money or less? Strong earnings signal economic health. Housing market data, rising home prices, and construction activity tend toward economic confidence, declining activity, contraction ahead. So where do we find this info? The Federal Reserve website. You can go for rates, inflation, and monetary policy. The Bureau of Labor Statistics can give you unemployment, wage data. Yahoo Finance, CNBC, Bloomberg can give you market indicators and overall investor sentiment. FRED, which is your Federal Reserve economic data, is covering your macroeconomic trends. Using TradingView, MarketWatch, Investing.com can give you real-time charts and analysis of different stocks and ETFs. So you don't need to become proficient. You don't need to be a stock trader or an economist. just track a few of these monthly. Over time, you'll start to feel the rhythm of the economy and be able to respond with more confidence. So the cycles aren't bad; they're just the reality. Um, the key is to maintain um, emotional stability during these ups and downs. Don't panic. Don't panic buy. Don't panic sell. Start learning how to ride the markets, how to ride these waves up and down. Smart money moves are really about timing the market. They're about knowing where you are in the cycle, knowing where companies and the economy are, and acting with a strategy. So next time you hear on the news or someone talking about that's a bad investment or the economy's crashing, take a bigger view and ask yourself, where are we in the cycles? And it will probably require some research for you. And then follow up with, well, what's the right move for me based on where we are in the cycles? I hope this helped. Um, Again, we're trying to get you a better idea of how to master your money to give you the best um, chance of growing your wealth over time. If you have any questions, comments, concerns, if you'd like me to delve into any of these topics in a little more detail, put stuff in the comments below, and let's all help each other build our financial IQ. All right. Thank you for joining me. Have a wonderful day.